Good day to all of you. Welcome to ODL session. This is Managerial Economic class, week 12, lecture 1. Today's topic, we are going to discuss about the break-even analysis. In this particular session, I am going to give some basic idea about break-even analysis. In the second session, that is next class, we will elaborate the break-even analysis. Let us get into the class. First, we should know what is break-even point is. In the break-even analysis, the prime objective of that particular concept is to find out the break-even point. So first we should have the definition. The break-even point may be defined as that level of sales in which the total revenues equal to the total cost and net income is equal to 0. This is also known as no profit, no loss point. This concept has been proved highly useful to the company executives in profit forecasting and profit planning, and also for examining the effect of alternative business management decision. Normally, this break-even point used to call it as BEP of the firm, which can be found out in two ways. What are they? It may be determined in terms of physical units, that is volume of output, or it may be determined in terms of money value, that is the value of sales. So first we will start with the physical unit. This method is convenient for a firm producing a physical product. The BEP is a number of units of product that should be sold to earn enough revenue just to cover what are all the expenses incurred in the production, both in the fixed expenses as well as the variable expenses. The firm does not earn any profit nor does it incur any loss. It is a meeting point of total revenue and the total cost curve of the firm. In terms of physical units, we have to say how much expenditure that we have made for that particular production. There are some expenses related with the fixed cost, some expenses with the variable cost. That total cost should be compensated by the sales value. This is the BEP in terms of physical unit. Now let us explain with a table. In the first column, output in units. In the second column, the total revenue earned. And the third column, fixed cost, and fourth is variable cost. So when we add these two, we can get the total cost. As the output increases 0 to 50, 50 to 100, 100 to 150, likewise it is increasing up to 300. What is the total revenue earned? The price of the product is 4 rupees. So when you produce 50 products, 50 into 4, 200. Likewise, it is increasing up to 1200. Now coming to the cost side, there are two types of cost, fixed cost and variable cost. The fixed cost will not be changed. For irrespective of output, there will be a constant cost. 150 rupees is a fixed cost. But variable cost is not like that. When the output increases, it will also increase. So the variable cost here is 3 rupees per product. So when 50 products are produced, the variable cost will be 150 rupees. When you produce 100, then it is 300. So when we add the third and fourth column, total fixed cost and the total variable cost, that is the last column, the total cost. So when we add, the total cost is initially it is 150 rupees only. Even though you are producing or not, we have to incur that fixed cost. And after that, 150 rupees fixed cost, 150 rupees variable cost, total cost is 300. Likewise, it is increasing. If you see the table, at 150 units as output, the total revenue is 600 and the total cost also 600. At that level of output, there will be a BEP, that is break even point. This is the easiest explanation. Some assumptions are made in order to explain the break even point. The price of the commodity kept constant at rupees 4. This is the first assumption for break-even analysis. So when we calculate the break-even, so we have to make a constancy in the price, and we are also assuming there is a perfect competition. Therefore, the total revenue is increasing proportionately with the output. All the units of output and are sold. That is the assumption. So the total fixed cost kept constant. It is 150. So these 5 assumptions is a basic assumption required in order to calculate the break-even point. Now, we will explain elaborately. The total variable cost is assumed to be increasing in a given amount throughout. From the table, we can see that when the output is 0, the firm incur only fixed cost. That is only 150. Fixed cost is 150, so total cost also 150. When the output is increased to 50, the total cost is 300. Why? 150 is a fixed cost, 3 rupees is a variable cost, total is 300 plus 300, 600. When the total revenue is only 200, so there is a loss of rupees 100. Only at the level of 150 units, the revenue is 600 and the total cost is also 600. There is no profit and no loss. At that level, we are having break even point with the physical units. This particular thing may be expressed either mathematically or graphically. First, we will start with the graph. When you plot that particular total cost and total revenue in a graph, then it is called break-even chart. Break-even chart are being used in recent years by the manager economists, the company executives and other government agency in order to find out the break-even point. In the break-even chart, the concept like total fixed cost, total variable cost, by adding these two, the total cost incurred and also the total revenue are shown separately. So there will be four different curves will be there. The break-even chart shows the extent of profit or a loss to the firm at a different level of activity. Now we can see the figure. In the next slide, we are having the figure. You can see in the x-axis we are calculating number of units produced, that is units of output. In y-axis, both cost and the revenue is measured. The curve FC, which is parallel to the output axis, that is it is parallel to the y because the cost is fixed. Irrespective of output, 150 rupees we are incurring. And another curve is total cost. The total cost nothing but the fixed cost plus variable cost. And how we have drawn the total revenue curve? If you draw a 45-degree line, that will do. So when you see the total revenue curve and the total cost curve, it is intersecting at the point B. At that point, the total revenue is equal to the total cost. It's nothing but break even point. After that OQ level of output, what are all the things we are having, that will be a profit zone, and less than that it will be loss. So the net profit or the net loss will be calculated based on that particular point. In that particular diagram, I already told in the horizontal cost and revenue, I'm sorry. In the diagram, output is measured in the horizontal axis and cost and revenue in the vertical axis. The total revenue curve is shown is linear and it is assumed that the price is constant irrespective of output. This assumption is appropriate only if the firm operating under perfectly competitive condition. The linearity in the total cost, that is TC curve, results from the assumption the constant variable cost. It should also be noted that the total revenue curve is drawn as a straight line through the origin. Why it is? Because it starts from 0. When 50 products are sold, then 50 into price, that will be a revenue. Likewise for cost, when 50 products are produced, 3 rupees variable cost, 150 rupees variable cost. So it will start from the origin. While the total cost of the straight line in a vertical axis, because the total cost comprises of both fixed cost and the variable cost. So in the figure, B is the break even point at the OQ level of output, as I told earlier. Now, how we have to prepare the break even chart and what are all the things to be considered for preparing the break even chart. First, we should know what approach that we are going to choose, whether it is a mathematical approach, graphical approach or linear approach. So first we have to decide. Then you should know what is output. You have to measure the output, and two different curves. One is the total cost curve, another one is the total revenue curve. So intersection of these two, at that point break even point will be. After knowing all these things, there will be a new concept called margin of safety. This is also important in order to find the equilibrium for the cost and revenue. Now, let us move to the determination of BEP. That is a formula for calculating the break-even point. Break-even point is nothing but total fixed cost by contribution margin per unit. We may ask, what is contribution margin? The contribution margin per unit can be found out by deducting, that is subtracting, the average variable cost from the selling price. Price minus average variable cost. So the formula will be BEP equal to fixed cost divided by selling price minus ABC. Now we have completed with the physical unit. Now we will come with the break-even point in terms of sales value. Suppose the business firm is a multi-product firm and it is not possible to measure break-even point with the one particular unit of product, because that is more different types of product are there. So we should know a advanced level of knowledge in order to find out the break-even point. It is convenient to determine the break-even point in terms of total rupee in sales. The first one is in physical units. If it is a single product. Multi-product means it is not possible to use that particular thing. Now we have to explain the break-even point in the money value. Here again the break-even point would be where the contribution margin. What is contribution? Total sales value minus total variable cost. There the selling price minus variable cost per unit. Here the sales value minus variable cost, total variable cost. So it should be equalized with the fixed cost. The contribution margin is however expressed in the ratio of sales. So by using this particular logic again, the break-even point is nothing but fixed cost divided by contribution ratio, their contribution margin, that is single product. For multiple product we have to say contribution ratio. What is contribution ratio? Total revenue minus total variable cost divided by total revenue. That's a very easy one. Total variable cost by total revenue will be the contribution ratio. Now we can explain this particular BEP in a sales value with a small numerical example. If total revenue is 600 and the total variable cost is 450, then what is the contribution ratio? It's very easy. 600 minus 450 divided by 600, which is nothing but 0.25. So once you calculated 0.25, then how to calculate break-even point? Already we know the formula, total fixed cost by contribution ratio. What is fixed cost? Here it is 150. So 150 divided by 0.25, which is equal to 600. So at sales value of 600, the firm can reach the break-even point. The firm achieve its BEP when the sales value is rupees 600. Why? Total revenue is 600, total cost is 600. So what is our net profit or loss? It is nil. When there is no profit and no loss, then it is break-even point. With this basic idea, one should answer these questions. You can able to write a short note on break-even analysis. There are some assumption. What is safety margin, or what is break-even point? All these things, no. Write a short note. Then oftenly asking a question: what is break-even point? What is break-even chart? What is targeted profit? And the last one, what is safety margin? So these questions will be answered in the second part of the break-even analysis. It is week number 12 and lecture number 2. In the next class, I will answer all these questions. Until then, goodbye. I am Dr. Chandrachud, Professor and Head, Department of Economics, School of Management Studies and Commerce, Wales Institute of Science and Technology and Advanced Studies. This is my email ID and this is my contact number. If you have any doubt, feel free to ask me. Until then, goodbye.